Hi, I'm Ravi Sood. I'm the CEO and chairman of Golconda Gold. We're a gold producer with an operation in South Africa called Galaxy Gold Mines and a new operation called the Summit Gold Mine, which we expect to commence operations in the middle of 2026, producing gold and silver.
Ravi, good to see you. So it's been a while, and we have caught up on the phone, but we haven't spoken about your company for a while. So Golconda, let's kind of really try and understand what the business model is there. It's your self-funded organic growth, it seems. What do we need to know?
So, the starting point for us is looking at opportunities and how the company was created was embracing the fact that there's a huge gulf between a great project, a great feasibility study, and something actually being in production. Very hard to cross that gulf, financing risk, permitting risk, execution risk. And if you have something that's crossed that gulf, whether it's in production or not, that's worth a lot. And it's in you trying to find those kind of opportunities where, because of circumstance, and the circumstance for the past 10 plus years has been a bear market and a really miserable market from a financing or from an operating perspective in precious metals, is to buy those kind of assets well. And in our case, we have the Galaxy mine in South Africa. We bought that out of a restructuring. Total cost to purchase that was nominal. It was the assumption of debt and the assumption of employees and an operating cost. And we also bought the Summit Gold Mine from which is in New Mexico in the United States. And that was through the liquidation of a private equity fund that had wrapped up and had hit its maturity date at the tail end of the bear market in precious metal. So again, something I think we bought very well, permitted, existing infrastructure, everything in place, ready to go. It just went into bankruptcy in the last cycle because of the decline in commodity prices. So that's really the sort of underlying or overarching strategy for us, is that there's a huge amount of value in that. And where it's put us today, sitting here in October 2025, is we've put Galaxy back into production. We're producing gold 365 days a year and benefiting from the gold price environment. And we were able to do that with relatively little capital because we were starting with something that was in production, and then do the same thing again with Summit without having to issue equity, issue a royalty, or even issue debt because we're self-funding it.
Right. Buying cheap and buying messy seems to be what you've been good at. I mean,
If there wasn't something wrong with it or some issue at some point in time, we wouldn't have had a shot at it.
Absolutely. No one wants anything with hair on it, apparently, except you. And now that's kind of paid off dividends for you. I think the last time I spoke to the company back in, crikey, I think it was like January 2024, 19 cents. We're sitting at what, $2.20, $2.30 at the moment. Timing is everything. But tell us about what you were doing during that kind of that period where you talk about these kind of bear markets, pretty horrific markets. How do you survive?
Well, it was really a batten down the hatches approach. So we've a little bit of a different capital structure to our company, which is I think governed our decision making, which in the difference with our capital structure is huge insider ownership. Insiders collectively owning just over 40% of the company. What does that mean? It means like we really care about the share count. We really look at our expenses. We're not living for salaries. We're really living for that share price and the future growth in it. And so that really dictated our decision making. So we tried to survive this bear market without issuing any shares. Because of that, we made some decisions which were, we did not good decisions, but they were decisions that were governed by the availability of cash as opposed to by good business planning or trying to invest for the future value of your business. So that's the negative part of it. The positive part was that we didn't blow up our capital structure and we retained that ownership. So we cut costs. We have a formula, I'll call it a 2/3, 1/3 formula. And most of the times that we're looking at these operations, it's kind of like 2/3 fixed costs, kind of an inflexible. And the longer that an operation's been running, the bigger it is, the higher your fixed cost component, which is kind of backwards. And what we want to get to is a reverse of that, is 2/3 variable costs and 1/3 fixed, meaning that as things get worse, as they tend to do in cyclical industries, you have more flexibility in terms of turning down the volume and reducing your costs. So that's absolutely what we did. And the mantra was batten down the hatches. When this turns, and it will turn at some point, and the commodity price moves, we're going to get it all back, and we'll get it all back pretty quickly when that happens. I never would have thought it would have taken as long as it has. I wouldn't have had the will to do it if I knew how long it would take. But once we were in it, we were in it. We had no choice. So the only way to do was hold on for dear life, and that's what we did. So we were in batten down the hatches mode for years, and there's no disguising that impacted our operation. We've had a lot of work to do over the last year to catch up on very basic sustaining capex and basic investments in our business, but we're doing it from our own cash flow as opposed to having to raise money to do it. So it's working out. Things are going the right way now, but it was a very difficult 10-year period.
I'm always intrigued by what people learn in the bad times as well as the good times. Have you seen that meme going around at the moment where there's a guy standing in front of the mirror telling himself, it's not a bull market, you're a genius? And I feel that that is just so apropos of how people in this sector can work. They don't sort of strengthen for the future. They want to spend the money now, thinking life
Absolutely.
will never short. Yeah.
No, in this sector more than any, and the first half of my career, almost 15 years, was in asset management, and I was on the other side of the desk. I was the guy investing in companies like my own. And, you'd see that so much, you do all this work as an investor. And, I think this company A is the greatest, and I think company B is the worst. But almost all of your return is by getting the sector right, getting your timing right on the market, despite what anybody says. That's where you're really going to generate a differentiated return. This sector is that on steroids. And, I'm fond of saying, in a raging bull market on precious metals, a room full of monkeys on typewriters, it can earn triple-digit returns. It's absolutely true. And I lived the reverse of it. So I've had a number of ventures, and you always start these things out with, you got to raise money and you got to get people excited about it. So you have a bit of optimism in your presentation, in your model, and your spreadsheet. And Golconda was no different. Every other venture that I've been behind or I've been an investor in support of hasn't really quite lived up to the spreadsheet. In some cases, they've done phenomenally well, and everybody's really succeeded in every way possible. But it's hard to live up to that initial optimistic spreadsheet. In the case of Golconda, everything. If I look back at the presentation from 2011, we beat on everything, and our stock went down 95%. Because gold was over $1,800 when we started the company in August 2011, and it troughed at about $1,050. And so there's nothing we could have done. We just did everything right, and the stock went down 95%. On the way up, I'd like to think we've done a whole bunch of things right in the last several years, but most of that has been appreciation in the commodity price. So maybe the genius was not dying when the commodity price was low, and I can take credit for that. But the good things that have happened on the way up, it's not rocket science what we've done. It's been very simple, investments in our business. The things that we knew that we had to do for years, we just couldn't, because we were managing to cash, not managing to what we knew had to be done. The commodity price has led to cash flow, which has led to cash, which has led to investments in our business and improving performance.
There you go. Amen. I think that's right. Absolutely right. The commodity price is a big determinant of that, and quite frankly, I think the last 5-6 years, possibly longer, has been the name of the game is to be in the game, to be able to play the game. And that's what you've done. Now let's talk about Galaxy, right? So Galaxy is obviously you've got a choice as to what you do with the kind of operating cash flow. What are you choosing to do with it in terms of reinvesting it, allocating to debt reduction, balance sheet strengthening? What do you go for?
So I'd say it's a waterfall. Number one is fixing our balance sheet. So most of that exercise is done. So we started the year with a line of credit with our off-taker. That's been completely repaid. We've probably over 1,000 days payable. So we really leaned on our creditors and all the service providers and counterparties that we've dealt with for years. They've helped keep us alive. So we're in the process of paying, and for the most part, I've paid everybody and brought them current. So huge win for us. Also, lifting the level of service that we get from our counterparties and service providers, since they've seen a lot of money from us. And really cemented or reinvigorated those relationships. Next up is investing in the business itself. So with Galaxy, we're over 2 million ounces, almost 2.4 million ounces of global resource. That's a number that can go up a lot. It doesn't really change our approach from a mining perspective. We are the beneficiary and also the victim of our existing infrastructure. And we've built a new mill and plant, and that can process 50,000 tons per month. Our utilization of that is still very low. We're sort of at the 30 to 40% at the best of times utilization rate. So lots of room to grow there without any capital expenditure. But on the mining side, we can get up to 40,000 plus tons a month. Like this year, 2025, we'll have averaged just over 10,000 tons per month of ore to that mill. Once we get that up to the 40,000, we're looking at more like 4,000 ounces of production a month. And we can do that for a very long time. So that organic reinvestment is the highest return thing that we can do. Now, as it happens, that's actually pretty small numbers to get there. We've gone through the hard yards. Like we plowed in money into a 2-kilometer new adit into the ore body. We plowed the money to build the mill. We plowed the money for the year plus of like figuring out getting all the gremlins out of our mining, the mining side of our business. So a lot of those big dollars are spent already. So it's pretty small dollars over the next several years, but that's the most obvious and highest return one on the triage. At some point in at these commodity prices early in 2026, we had approximately $30 million US of tax pools that we'd built up and for the most part inherited when we acquired this asset. We'll have used all those up. We'll generate a lot of cash above and beyond that debt repayment, creditor repayment, and funding all of our internal CapEx in the first half of next year. And we have to take a serious look at what are we doing with that money. First choice, again, is we're funding the start at Summit, our operation in the United States. Again, we already own it. All the infrastructure's there, so very high return use of that capital internally. But it's peanuts compared to what the cash flow that we can generate from Galaxy in the coming years in this kind of gold price environment. So baseline is to do nothing, and do nothing means have a good balance sheet and return capital to shareholders. From my point of view, I don't really care how we do it as long as it's the most tax effective relative to where we're trading. I think if the share price is lower, that favors share buybacks more so than it does dividend. If the share price is very high, then it's going to favor dividend more. But the answer may very well be both, a little bit from column A and a little bit from column B. If we find another opportunity that resembles what we did and what matches the sort of mantra and DNA of our company, buying something like we did with Galaxy or with Summit, I won't be afraid to pull the trigger. What I don't want to do is put ourselves in a position where we have to dilute ourselves or take on sort of this dip type where we're plowing money into an asset to get into production for several years. We don't know when the cycle is going to end. And the cycle can end without the commodity price coming down. Gold could be at 10,000 and the cycle of really winning might be largely over. How is that possible, Ravi? That doesn't make any sense. It can be cost inflation. It can be government saying, wait a minute, gold's at $10,000. I'm going to jack the royalties or I'm going to put a windfall tax on precious metals production. It can kill the economics in many different ways. Right now, it's windfall economics because the costs haven't moved up. Oil price and energy prices are still quite low and our revenue line's going through the roof. So this is the proverbial sun shining, and I want to be in the position to continue making hay. So it's the biggest beneficiary of money coming out to shareholders is me. So I don't have a problem with that. That's assume I will obey the laws of physics, and I will treat myself well as a shareholder. There's no doubt about that. But if that opportunity comes along which matches our requirements, that's something we would look at. Right now we don't have anything. We're very much focused on just continuing to execute on the growth at Galaxy and get Summit up and running.
Okay, so it sounds like it's a kind of well, ideally a kind of risk-off environment. You took you talked about your view on avoiding dilution. There's a significant 40% plus insider ownership, but you've got to say in these projects, which I think back in the day most people wouldn't wanted to have had to have dealt with. You've got them in South Africa and Mexico, right? So
New Mexico, United States.
New Mexico, where you different FX currencies. You've got the tight ownership at headco level, but with I think if I remember, Galaxy's also got a kind of a different sort of ownership structure, has it not, that you're coping with? Is that right?
Yeah, and that's relevant to our decision-making process as well. So a lot of the questions we get are, hey, you get this 2 million plus ounce ore body, and with no hyperbole, like if we don't invest anything in exploration, we don't need to. But if we did, we could invest very modestly in exploration and increase that number by a lot. The reason why we don't do it is it doesn't change anything for our mine plan. So it's maybe trying to do something for capital markets, but that's just not where we're at. So our investments are around making sure that our costs are as low as possible and our production's as high as possible. So but 2 million plus ounces already, why aren't you trying to increase your production profile to 100,000 ounces a year for a 20-year mine life? That would make more sense, wouldn't it? And you already own the thing. I think that's risk management. That's me having operated in Africa for 20 plus years at various levels, but mostly as a owner operator. South Africa is a pretty good place to do business. I think gets too much of a knock. I've worked for extended periods of time in the Congo and Liberia, elsewhere throughout Africa. Most of the issues I call them micro. It's not the government coming and swooping in and stealing your asset. It's getting your equipment in, finding people to work there that are at least a C or B team and not the D or E team, never mind A team, financing things, just general logistics, basics, not having power in roads. In South Africa, like where we are, we're on sealed roads. Not that it's the hallmark of civilization. There's a KFC and McDonald's, within 15 minutes drive of our mine. Yeah, I mean, it is very easy to operate there. You can live there in a very nice house, and we have grid power. I can fly there from Canada and be there in under 20 hours after making all the connections and driving. It's very accessible. However, it's still Africa, and the 50-year-old version of me looks at it and says, okay, we own 74% of this, as there's a requirement for black empowerment in South Africa. It's been there for decades. The program's had some level of success, but it is what it is. There's periodically rule changes around it, but it's more or less something like that. Given that it hasn't affected us to date, but once we're through this sort of pool of tax losses and the company's fully profitable from an accounting perspective, to take money out, we only own 74% of it. So every dollar of energy, there's dollar of capital, but there's also every dollar of energy and mind share that we're putting to it. We're only getting 74 cents on the dollar of benefit. We're also fully taxable as we get through those pools next year. So again, nothing wrong with paying tax. It means that you're making an actual real profit. And that's where we're going to be next year. But to me, I'm in harvest mode on Galaxy. It means, yep, we could make a big capital investment, fundamentally change the underground infrastructure that we have. It would make sense on a spreadsheet. It'll show a really high NPV, but that's not, I'm not managing to an NPV. You could say, well, he's not managing to ounces. He's managing to value creation, the NPV. I'm not even doing that. I'm managing to cash. And at this point, I'll take the W. If I can get this to 4,000 ounces a month with a 50 plus year mine life, I'll take the W, and I'll take the cash out, risk management all day long. And we'll either return it to shareholders or we'll do something else in another jurisdiction, like we're doing with Summit. In this case, I'd say it's a better jurisdiction, United States. No jurisdiction's perfect. And maybe that we find an opportunity that's someplace in between. We'll see. Nothing on the table.
But let's remind people about some of those numbers are. In terms of that production profile, you've got you've indicated a sort of ramp up through to 2028. So what does it look like today, and what does it get to?
So the guidance we've given is for just over 10,000 ounces in 2025, and it's public record. It's very profitable at that level of production. We're exiting the year, and we've already put out our Q3 production numbers, and another couple months you'll see the Q4 numbers at a run rate that matches our guidance for 2026, which is 18,000 ounces roughly from Galaxy, and so that's about 1,500 ounces a month. And then we're on a not straight line. It's not a straight line because it's depends on where we are in the underground development and accessing the different ore bodies, opening up new faces to get the higher volume of ore to our mill over the next between now and 2028, getting that up to just over 40,000 ounces a year. And the mill's already big enough to handle all of that, and the infrastructure is there. So it's really just passage of time. The good news is we're making profits throughout the whole piece.
Okay, but is there are you giving any kind of future guidelines beyond 2026?
Yeah, I think it's 21,000 the year hence, then 28, and then we're up to the full 40,000 tons a month. So it gets us just over 40,000 ounces a year from just Galaxy. On Summit, our guidance for next year is just 2,000 ounces, and then it ramps another slower year. Again, it's a function of underground development. Approximately 10,000 ounces in 2027, and then on average, again, it's lumpy. It's about 1,000 ounces a month, or 12,000 gold equivalent ounces a year. It's not all gold in that case. It's about 60% gold and 40% silver. So again, the gold equivalent number will go up and down depending on your ratio. But based on today's ratio, it's almost spot on 1,000 gold equivalent ounces a month.
Okay. Right. So I kind of building a picture of the type of company you are, and what I'd be getting into as an investor. In terms of just conscious of time, just if I can jump to Summit, regards to the funding as part of that restart, is that all coming out of cash flow? Because you've kind of got this reading non-dilutive funding approach, haven't you?
Yeah, and our intention all along was to do it with debt and not to dilute. And as a result, it'll have been half a decade that we've sat on the asset. There is just no funding environment, and immediately we bought it during the sort of the tail end of COVID, and there was no capital for small mining projects whatsoever, and that was fine. I really viewed it as a portfolio asset, and this is something that we could switch on when the commodity price environment was right. And things started to open up 2023, and in 2024, a lot of interest, off-takers interested in funding us, prepay, royalty, even debt. And we didn't do anything in 2024 because it was what I characterize opening up a war on a second front. So we're still getting Galaxy to work, and we were still dealing with balance sheet issues at Golconda. Fast forward to 2025, higher gold price, more progress at Galaxy. Our cash flow was able to sort of cover us out of our balance sheet issues at a Golconda level. We're now in excellent shape, and we're exiting the year net cash, no debt. And we have visibility on 2026, being able to easily self-fund Summit to the point that we don't even need any debt for Summit to bring it into production. So from an operating point of view, from a financial risk point of view, a lot more comfortable. So, and the war, I don't have a war on a second front because I've resolved the first war, and we can really focus on whatever Summit throws at us in terms of the commissioning process.
Right, and just right, but it's a restart we're dealing with here, so let's be clear about that. In terms of any kind of economics that you've tried to update and wrap around this, what's the AISC look like? What's the life of mine?
So the AISC on Summit is around number $1,600. It's a very high-grade mine, but it is small, so you're absorbing a fixed cost across a small number of ounces, and we're using contract mining. Why are we using contract mining? It adds a lot to the operating costs. That's one of the failures of, one of the serious challenges that the previous operation had was owner mining. You are dealing with a small mine in sort of the far corner of New Mexico, and getting a team to staff it, maintaining your equipment when you have that small operating base, not easy. So strong preference from our point of view to use a contractor that we can put KPIs on, that has their own, management systems that are amortized over a much larger mining fleet and can source people and parachute them in and out. So huge benefit for us to deal with that much higher AISC. That is obviously very well absorbed by today's commodity price. So even the modest production base of 1,000 ounces a month, outstanding margins from an absolute unit basis and on an absolute basis. Life of mine currently at 7 years, so a very different picture than Galaxy. Offsetting that is it's deja vu all over again from what we did with our starter asset that we created the company on, which was taking, this is geology and work that was done in this case when gold was around 600, silver was about $14, and looking at it first with what's already there and in the model and just tweaking the price and looking at the shapes of the ore bodies and what's economic at $3,000 gold, $4,000 gold, $40, $45, $50 silver. Totally different picture. We have nothing compliant that we can share, but a totally different picture. And then doing some exploration work, basically following up on hits that were stuff that they walked away from 15 years ago, and rightly so, that are clearly going to produce economic ore bodies in today's environment. And we have the mill, we have the permits, we have the tailings. We'll keep this thing going for a very long time. Nothing compliant to share yet, but we will.
Okay, so just again, I guess it kind of follows suit with what you talked about in South Africa. You get this thing in production; it's got a decent enough starter life to it. Outsource or contracting, and then you will, I guess, ramp up the exploration accordingly, but no rush to spend money or raise money anytime soon.
Yeah, and in no case would we have to raise any money for even the exploration. This is near mine exploration, modest expenditure. A lot of it's desktop work in the first case, just redoing existing data using higher commodity prices and creating new models. And the big leverage point for us is that we have a permitted mill and tailings facility. So that's very difficult to do in New Mexico. It's very difficult to do anywhere. But that's a huge value creation point for us at lever.
Brilliant. Like Ravi, okay, look, I'm a good kind of catch up on where you're at. It might be worth you coming back on and get into the weeds a little bit with Summit Mine and Banner Mill. And
I would love to.
And in Galaxy Gold Mine, maybe even with one of your ops team. That'd be fantastic. Appreciate your time today. Well done. The stock has performed. I felt the need to reach out. Well done.
Thank you.